A bunch of monthly numbers have hit us. The October trade numbers that came yesterday showed that the goods trade deficit was the highest ever monthly tally at $31.46 billion. And the deficit is high at a time when FPIs are largely selling stocks and pulling out money. So, in a way, financing deficit could be a problem. Separately, inflation in the US and India are falling. That's the other set of important data. But can we say with any certainty that the threat to emerging market currencies like rupee from high US yields is over? Can the Reserve Bank relax? Then, of course, there is the election and likely fiscal deficit issues too. To discuss all these on the state of the Indian macros, I'm joined by Samiran Chakraborty, the Chief Economist, India at Citibank, and Mitul Kotecha, the Head FX and EM Macro Strategy at Barclays in Asia. Gentlemen, thank you very much for your time. Samiran, first to you, the trade deficit numbers, 31 billion goods, even if you add services, it's a deficit of $17 billion. And only during that post-Ukraine month, we have had that kind of a deficit, 20 billion, when crude was at $120 and $110. So should we worry that this deficit is alarming?
Good morning, Latha. In isolation, the number does look to be very large, but if you parse through the details, what comes out is that on a month-over-month basis, there has been about a $11-12 billion increase in imports, and exports have been flattish. And if you further drill down into what is causing these imports to go up, out of this $11-12 billion increase in imports, almost $8 billion is caused by different commodities like oil, gold, and silver. So the increase in core imports is only about $2 billion. So to the extent that this is showing the strength of economic growth in India, I think there is nothing, it's not a cause of worry as such. We think that the monthly trade deficit trends, once this oil price increase effect fades out, oil prices have already come off, then the monthly trade deficit would veer back into that 22-23 billion, that sort of a mark for the rest of the year. That would yield a current account deficit of about 1.7% of GDP for the full year, which is fundable, but at the same time, we must say that the best of the BOP is behind us. The first quarter, FY24, was probably the best quarter. From here on, it's the second quarter and third quarter likely to be BOP deficit. The last quarter could turn into surplus if we see some global bond index inclusion-related inflows to front-run the news. And the bigger worry is that the FDI numbers are very, very weak. So we will hope that for the rest of the year, that number picks up. But overall, the best of BOP is behind us. But at the same time, the trade deficit number should also moderate as we go forward.
Okay. Now, besides this trade deficit moderating, Samiran, just finish with you before I get to Mitul on the levels. Do you think that the government putting in rules like, tax collection at source, which kicked in only last month, November, right, if I'm not mistaken. So will that be an automatic stabilizer, and expenditure, the current expenditure will anyway fall? So that's not, that's another antidote to worrying too much about deficit.
So Latha, that will probably impact more the current account deficit rather than the trade deficit as such, and may take a while to fully pass through the system. As of now, we don't know what exactly is happening on those outflows. So we'll probably wait to see that play out. But overall, the 1.7% of GDP current account deficit that we are forecasting is not alarming as such. We generally say that 2 to 2.5% of GDP of current account is easily fundable in a country like India, which has generally attracted a lot of capital flows.
Oh, yes, absolutely. We have seen a couple of decades of over 2% current account deficit. So while 1.7 is a little worse than the 1.4, perhaps, which economists thought, it's not so bad. But Mitul, good morning and thank you very much for joining us. The threat to EM currencies or whatever, worries to EM currencies has more emanated from the US yields. The PPI inflation and the CPI inflation have pulled down yields. But how do you see US yields, say, over the next 6 months? Is the worst behind us or can the threat re-emerge?
Yeah, and look, it's a very good question. I think US yields, in our view, will still remain elevated. And as you said, we've had a big pullback. Clearly, the CPI in the US and the PPI data were softer than anticipated. But that said, look, some of this is probably likely to be sticky in terms of inflation. We think the market reaction may be overdone in terms of the pullback in the dollar and US rates. And we would expect rates to continue to be elevated. US is still showing growth exceptionalism. The rest of the world is still under some degree of pressure. When you look at Europe, for instance, and even China in terms of its growth progress. So that may just keep rates higher and the dollar on the front foot. And that potentially could still be a problem for emerging markets in the next several months. So our view, and we've just put out our latest quarterly forecast, is that dollar continues to remain fairly strong into the next few months, into Q1, where afterwards we do see some moderation in the dollar as we go through the remainder of next year. But for now, that should, as I mentioned, keep EM and EM Asian currencies on the back foot into the next few weeks, including the rupee, which remains fairly tightly range bound for now. But our view is ultimately the rupee could see a weaker footing as we go into next year, potentially around 83.8, before we see some downward move in dollar rupee.
What's the levels you have in mind for the dollar index itself?
Well, DXY, I mean, again, if we're assuming here the dollar remains fairly firm, we could probably see at least a couple of percent move higher in the DXY from these sort of levels, if not more, depending on, again, whether the Fed does hike or not and whether US yields remain elevated. Now, we still forecast the Fed to hike early next year. We think the market's underpricing that probability given the strength of the US economy and sticky inflation pressures, and that could still drive the dollar higher from here.
Oh, you're expecting another rate hike from the Fed next year?
That's right. That's our house call. We still think the risks are skewed towards more tightening from these levels. Now, the Fed is talking about financial conditions easing again or strengthening in the last several weeks and months, and that potentially could impact the potential for higher rates. But again, if you look recently, financial conditions have eased, so it's a bit of circularity. Easing financial conditions could push the Fed to hike rates again. So we wouldn't rule out another hike early next year from the Fed.
So your range for the US yields and your range for the dollar index in exact numbers, you said 1 or 2%. So you're expecting what, 107, 108 on the DXY? And
correct.
yields
So
likewise?
we would see. Yeah, look, we don't have an official forecast on DXY, but if we're right, we would probably potentially could see a move up to around that sort of 106, 107 levels. Again, we look at US yields, again, the 10-year, it's not far from where we would forecast in the next few months, around this 4.5% level. But the point for us is that we don't see yields easing very quickly in the US. And there's going to be a fair amount of bond supply. The fiscal picture in the US is still showing some widening in the deficit. We've not seen the big buyers like the Fed and other Asian central banks. And all of that could weigh on US treasuries as we go through next year.
That's absolutely the point. The US yield, the term premium did not rise because of any new inflation number, but because the Treasury announced, the bond issuance in September, late September was it, or early October. That's when you saw this huge jump in the term premium. Samiran, I know this is not exactly your area of inquiry, but do you think the Reserve Bank will continue to have to worry about this interest rate differential? Do you still see trouble from that quarter because of the high US fisc?
So, Latha, I mean, again, most likely the US yields, if it stays around the current levels, then it's about 50 odd basis points lower from the peak. So in some sense, the RBI could have a sigh of relief that they're dealing with less of a interest rate differential issue than it was maybe couple of months back. So, and if in the November Fed meeting, the tone of Fed also becomes slightly softer, then in the December policy, that could become a positive backdrop for RBI. Now, the channels through which generally this interest rate differential impacts us, at least one of the channels, the debt FPI inflow has not been impacted because of the bond index inclusion news. From the time that news came in, we have actually seen $2 billion of inflows through the FPI bond route. And that shows that the interest rate differential is not having a big impact on that. The other route, the ECB flows, the data is a bit lagged, but again, doesn't seem to be a massive outflow on that front as well. So from that perspective, there is no immediate risk to the currency or macro stability emerging from this interest rate differential argument. But this is such a basic 101 macro issue that I don't think any central bank can completely have a blind eye towards it. So I'm sure that RBI would also be looking at it quite closely, and it will have an impact on its policies for sure.
Okay, I'm being warned on time, but Samiran, what about inflation? Since it's like below 5%, do you think we are safe on the inflation front? The Reserve Bank can relax a bit and be less tight in its monetary policy, in its liquidity policy?
Well, it's a bit of a dichotomy that the core inflation numbers are extremely benign. Every month, it's almost surprising on the downside a bit. But at the same time, the food inflation problems is just moving from one item to another. Now, since the tomato inflation is behind us, it seems that onion is taking the place of tomatoes. So there's not really a big respite over the next 2 months. We think that the next two prints could be in the range of 5.6 to 5.9%, pretty close to that 6% mark. And that's why it's difficult for RBI to immediately move into some sort of an easing mindset. So they'll probably wait for a more sustained drop towards the 4% mark, observe that, and then only consider some easing, which we think is not before middle of next year.
Okay. Sorry, Mitul, out of time, but any range on the Indian 10-year?
No, well, yeah, look, we think probably we've already dropped below the levels we'd forecast. We thought 7.3% by end of this year. We're already below that. But we do think going into next year, we could see rates, 10-year yields going down to about 7% for 10-year IGBs. So we do see some lowering in yield. Obviously, index inclusion, we'll see passive inflows. We're looking at about $20 to $25 billion of inflows there. But at the same time, markets are wary of OMO sales by the RBI, and that may just keep yields a little bit more elevated than otherwise would be the case.
Okay. Thank you very much, gentlemen. Unfortunately, too many questions in too little time, but thank you very much for answering our queries. Trade deficit, according to Samiran, may be a one-off and things may soften a bit. Mitul Kotecha expecting a softening on yields, but on the dollar-rupee itself, he does expect the rupee to weaken a little more. We wrap up on Bazaar on that note. Chartbusters up next.